Everyone's goal is to be financially free, but with the existential crash of every financial market looming, the goal seems impossible. However, what if I told you there was a way for you to earn passive monthly income without having to do anything? Sounds impossible, right? So whether you believe me or not, you should know that dividend ETFs that pay monthly is the best investment in economic uncertainty. So, you should watch this video to know the 7 best monthly dividends ETFs that can save your finances during these unprecedented times. Let's get started. So, ranking 7th on this list is PAY, also known as the Invesco High Yield Equity Dividend ETF. This ETF is based on the Nasdaq US Dividend Archivers 50 Index, which invest in 50 equities based on dividend yield and growth consistency. The price of one share of PAY is now $20.63, with a 52-week low of $18.53 and a 52-week high of $22.68. As you can see, we have a good expense ratio of 0.52%, a dividend yield of 4.55%, and net assets of $1.23 billion, which is not shabby. The year-to-date daily total return is 0.62%, and the expense ratio is 0.52% over the category average. The sector weightings of the ETF indicate that it is strongly engaged in financial services, consumer defense, healthcare, and utilities. The fund's top 3 holdings are ULTRIA Group, 1OK Inc., and ATT Incorporated. So, why is PAY a good dividend ETF for you to invest in? With the dividend yield of 4.5%, PAY offers a significantly more appealing income. They have also increased by 20% over the previous 5 years, which means that if you put $10,000 in payback then, you would currently have almost $12,000 in the account, and that is before factoring in the dividends you would have received over the entire period. Overall, PAY is a wonderful option for building a secure, diversified stock portfolio that will be able to pay you a respectable amount in dividends every month, regardless of market circumstances. Next on the list is the DHS, also called the Wisdom Tree US High Dividend Fund. The Wisdom Tree US High Dividend Fund, DHS, replicates the Wisdom Tree High Dividend Index, a fundamentally weighted index that includes corporations with average daily trading volumes of at least $200 million. In the U.S. stock market, this ETF aims to track the performance of investments made by strong dividend-paying firms. Furthermore, by buying shares of this EFT, you immediately provide your portfolio with targeted exposure to the top dividend-paying stocks on the U.S. stock market. The price of one share of DHS, as of August 2022, was $87. The fund's assets are well diversified across industries, including consumer staples, utilities, real estate, and healthcare. The companies that DHS has the most stock in is Verizon Communications Inc., Pfizer Incorporated, ATT Incorporated, Phillips Morris, and the Coca-Cola Company. This ETF's high dividend yield comes to 3.77%. Certain what's going through your mind is, the dividend is quite low. I assure you it has a high growth price appreciation. Over the previous 10 years, DHS has had an average annual return of roughly 11.57%. This ETF has $1.2 billion in net assets as of mid-2022, and an expense ratio of 0.38%. DHS is an excellent monthly dividend ETF, and any investor looking for income should consider it. So, what other benefits does this ETF fund offer you? Stability and less volatility. Then, 5th on this list is the Invesco SP 500 High Dividend Low Volatility ETF, known as SPHD. The SP 500 Low Volatility High Dividend Index, on which the SPHD is based, tracks the performance of the 50 SP 500 equities with the highest dividend yield while also being the least volatile. The Invesco SP 500 High Dividend Low Volatility ETF seeks stocks with high dividend yield and low volatility. Since SPHD was built on the index, it's a good option for your dividend portfolio. This index was created as a benchmark for investors, hoping to receive income from their investments. Common stocks in SP 500 Low Volatility High dividend index companies account for 90% of total assets. The fund focuses mostly on utilities and consumer defense. Altria Group Inc., ATT Inc., ExxonMobil Corp., Fernando Inage Corp., and Iron Mountain Inc. are a few of the companies held. As of mid-2022, the net assets of this ETF were $4 billion, while the share price of SPHD was $47 in August of the same year. You will receive a monthly dividend of 3.86% from this ETF. The expenditure ratio is 0.3%, which implies that for every $10,000 invested, you'll pay $300 annually. Without question, SPHD is a good alternative for you if you're an income investor or want to live off your dividend payments. This is an excellent ETF fund, but are there better ones on this list? Coming in fourth on the list is PGX. Also called Invesco Preferred ETF. Another yield-producing, preferred stock ETF is the Invesco Preferred Fund, PGX. The objective of PGX is to mirror the performance of the ICE both AML Core Plus Fixed Rate Preferred Securities Index. What a strange name. The goal of PGX is to imitate the yield and performance of the ICE, both AML Core Plus Fixed Rate Preferred Securities Index. This exchange-traded fund, ETF, uses a market capitalization weighted index to gauge the fixed-rate market for preferred securities, dominated in US dollars in terms of total return performance. It implies that PGX exclusively purchases preferred stock shares for its investments. So, what are preferred stocks? A special class of stock known as preferred shares pays a predetermined regular dividend, similar to a bond, and are noted for giving out greater dividend yield than regular shares. ATT, Citigroup Inc., JP Morgan Chase Company, Wells Fargo Company, Bank of America Corp., and JP Morgan Chase Company are a few investments in this ETF. One share of PGX was priced at $13 in August of 2022. And this ETF had net assets of $5.8 billion as of mid-2022. The expense ratio on PGX is a little higher than 0.52%, which means you'll spend $52 per year on $10,000 invested, but because this ETF exclusively invests in preferred stock, it doesn't tell a little less risk. So, there is a common similarity among all the dividends I have discussed. Have you noticed it? Well, if you haven't, I will explain after the next dividend ETF I talk about. Next, the Global X Super Dividend US ETF is called DIV. DIV invest in stocks with low volatility and high dividend yields within the US stock market. The Global X US Super Dividend DIV Fund, established in 2013, focuses on a selection of high-yielding low-volatility securities. Even though this ETF's growth is slightly slower than average, it makes up for its high dividend yield. This ETF fund is relatively new and you can't track its 10-year performance. The dividend yield on DIV is 5.61%, but it also has a 0.45% expense ratio, which means that for every $10,000 invested, you'll pay $45 in fees annually. This ETF fund aims to monitor the performance of 50 equally weighted MLPs, REITs, and common stocks within the United States. A share of the DIV ETF costs $21, and as of mid-2022, it had net assets of $737 million. The securities included in the index have among the highest yields in the country, and are less volatile than the market as a whole. The ETF fund's holdings include Public Storage, Iron Mountain Inc., Holly Energy Partners LP, CubeSmart, and Clearway Energy, despite having a lower annual return and a higher expense ratio. DIV has a higher dividend yield, so you notice that all the dividend ETFs talked about is based on the US economy. The next dividend ETF will be based on companies outside and within the US economy. So, how are these ETF dividends different? The second ETF on the list is the Global X Super Dividend ETF, also known as SDIV. The DIV ETF fund and the SDIV or Global X Super Dividend ETF are very similar. There is a slight difference between this and another ETF produced by the same company. This ETF differs from others in that it holds 100 of the highest dividend-yielding stocks worldwide, as opposed to 50 of the highest dividend-yielding stocks in the US. The fund invests in common stocks, real estate investment trusts, REITs, and master limited partnerships, MLPs, all of which are required to meet certain criteria to be included in the index, including having strong returns and lower than average volatility. Iron Mountain Inc. Electra Consumer Products, Fortescue Metals Group, Yensu Coal Mining Company, and Omega Healthcare are a few of the fund's top holdings. The average return on this ETF over the past 10 years has only been 3.1%, which means that $10,000 invested 10 years ago would only be worth about $13,600 today. As a result, even though your hypothetical $10,000 investment is not depreciating, it is not increasing as much as it would if you had invested in a growth ETF. The SDIV has a share price of $9.35 and a net asset value of $788 million as of mid-2022. Given that this stock invests heavily in foreign stocks, which frequently have higher volatility than American stocks, SDIV currently has a dividend yield of 6.83%, and, like all the ETFs on this list, pays a monthly dividend, with an expense ratio of 0.59%. This ETF is unquestionably on the priciest end of the spectrum. On a $10,000 investment, you'll pay $59 annually. So how is this ETF dividend good for you? SDIV spreads your money across different countries' economies, lowering your risk. Sounds nice, right? Finally, the best is KBW, also known as the Invesco KBW High Dividend Yield Financial ETF. This ETF is based on one of the prominent Keefe's, Gruyette, and Wood's NASDAQ indexes. The KBW NASDAQ Financial Sector Dividend Yield Index is the foundation for the Invesco KBW High Dividend Yield Financial ETF. Fund Index. In general, the fund will invest at least 90% of its total assets in securities of publicly traded financial corporations in the United States with competitive dividend yields, which compose the index. KBWD strives to expose you to the financial industry in the United States. The fund employs a modified dividend wing approach in addition to choosing stocks with competitive dividend yields. The current 10-year average is about 8.75% per year, which means that $10,000 invested 10 years ago would have increased to somewhere in the upper $19,000 range. The KBWD has an equity ratio of 2.59% and net assets of $449 million. Although this ETF's performance won't ever be able to compete against things like Cathie Wood's ARK ETF, it's still a relatively good performing ETF, especially for something that pays such a high dividend yield. Due to its underweighting of insurance firms and overweighting of REITs and private equity, the fund's dividend-centric strategy also results in significant sector bets. The index is rebalanced and reconstituted quarterly, while the names of the company's stocks are unknown. These stocks are solid. Its top 5 holdings include Orchard Island Capital Incorporated, Chimera Investment Corporation, Armor Residential REIT Incorporated, AGC Investment Trust TCG DDC Incorporated, and One Main Holdings Incorporated. These companies provide you with financial services like banking, insurance, and the credit card you use. This ETF offers you a dividend yield of 8.81%. Guys, that's all for today's video. So which ETF dividend best suits your portfolio? While the ETFs listed here have a high dividend yield with a considerable expense ratio, other risk factors should be considered when deciding which ETFs to choose for your investment portfolio. I hope you enjoyed the video. If so, kindly hit the like button. Don't forget to subscribe to our channel to see even more of our incredible financial videos. You can also watch the other videos we've chosen just for you. Until the following video, take care.